everyone. So yesterday, a startup founder that I mentor had some news. They were made an offer by a marketing company to do some marketing for them in exchange for 10% of the startup's sales revenue. Sounds like a pretty good deal, right? They get 10%, you get 90%, and in exchange, they do the marketing that you so desperately need. Well, not so much. What could possibly go wrong? Well, as it turns out, quite a lot. Okay, there's a couple of basic accounting concepts that come into play here. On your income statement, arguably the most important of the financial statements, you have a top line and a bottom line. Top line is your sales revenue. That's the amount of money you get from selling your stuff. And after you have deducted all your costs and expenses, you're left with the bottom line, your profit margin, sometimes called net income, sometimes called profit. That's what you get to keep. Now, depending on what industry you're in, different industries have different average profit margins. Some are really big, some are really small. For example, in the airline business, profit margins are around 0.75%, which means that if you make $100,000 worth of sales, you get to keep $750 as profit. Pretty tight. In retail, depending on the type of retail, it's usually a little bit higher, somewhere between 5% and 10% in that ballpark. Computer hardware, for example, it's around 15%. So for $100,000 worth of sales, you get to keep $15,000 profit at the end of the year. And the business that's really my background, industrial services, our profit margins in that business were about 30%. So for every $100,000 of sales, we got to keep about $30,000 net income. Pretty good. Now let's think about this for a second. If you enter into a deal where you give away 10% of your sales revenue to somebody, and you happen to be in an industry where your profit margin is, say, 10%, which is not uncommon, then you will have given away all your profit to the marketing company. Let's go through the numbers very quickly. If you make $100,000 worth of sales and you get to keep $10,000 profit, but yet you owe 10% of $100,000, which is also $10,000 to the marketing company, you've given away your entire profit. This shows an interesting characteristic of the income statement. Small percentage changes of your sales revenue can have a huge effect on your profit margin. Little changes in the top line can have a huge impact on the bottom line. This also incidentally applies to discounts. If you have a customer that insists upon a volume discount because they buy so much of your product and you're tempted to give them, say, a 5% discount, so they pay 95% of the sticker price, well, if you were in a business where you had 10% profit margin, you've just cut your profits in half for that customer. So you've gone from making 10% profit to 5% for that particular customer. So everyone should be aware of this and not make the mistake of giving away their entire profit when they don't realize it. If this video was helpful or informative to you, please hit the like button and subscribe to my YouTube channel. Also, please consider supporting me on Patreon for a whole bunch of extra stuff, including extra videos that go into way more detail. I'm Bill, the company's expert, wishing you happiness, prosperity, and have yourself an amazing day.